In this video, I will dive into IFRS 9, which is the accounting standard that governs financial instruments, which is absolutely a challenging mission, as in nature, the relevant business and the corresponding accounting treatments are complex and complicated, and a lot of professional judgments shall be employed. Like all those SPPI tests, amortized cost, fair value through P&L, fair value through other comprehensive income, with or without recycling to P&L, weighted average of credit loss, 12-month expected credit loss, lifetime expected credit loss, etc. IFRS 9 is extremely important for financial institutions like banks, and you can also expect that any company that holds financial assets or issues financial liabilities would have to deal with it. My lecture will be covering 3 parts. First, understand how IFRS 9 classifies and measures financial assets. Second, understand how IFRS 9 measures financial liabilities. Third, understand the expected credit loss model and impairment. I will walk through these 3 parts with practical examples and detailed journal entries, which will help you understand IFRS 9. All right, let's begin with part 1, financial assets. The IFRS 9 classification model for the financial assets is like a 2-step decision tree, which comes down to 2 basic questions. Question 1, what's your business model? Are you holding these assets to collect cash flows, like a bank holds loans? Or are you trading them to make a profit? Or you hold it mainly to collect cash flows, but you also sell them from time to time? Question 2, regarding cash flow characteristics. Do the cash flows pass SPPI? So here, SPPI means solely payments of principal and interest. In simple English, does this financial assets behave like a basic loan? If so, it passes SPPI. If it has other features like leverage or equity index linkage, then it fails SPPI. In all business models, if it fails SPPI, then it would have to be fair value through P&L. Otherwise, depending on the business model, it can be amortized cost, fair value through other comprehensive income, or fair value through P&L. Please pay attention to this table. This is actually at the heart of IFRS 9. I would kindly ask you to understand and memorize this table, and most of the standards will become intuitive. Now, I will continue with financial assets by splitting the discussion into debt and equity instrument, because IFRS 9 treats them very differently. The debt instruments can be classified as 3 types: amortized cost, fair value through other comprehensive income, and fair value through P&L. This depends on the business model and the SPPI result. I'd like to remind you that amortized cost uses the effective interest rate method, fair value through other comprehensive income goes to other comprehensive income. But when you sell, you will have to recycle the gain or loss to P&L. And all debt instruments are subject to expected credit loss. Even the fair value through other comprehensive income debt instruments. I will explain each of them with separate examples. First, amortized cost. Let's imagine the company buys a simple government bond and intends to hold it to its maturity. The face value is 1,000. The purchase price 950. The coupon rate is 5%. Maturity is 3 years. Let's make a step-by-step analysis. Step 1, business model. As the government bond is held to collect contractual cash flows, so the business model is hold to collect. And step 2, SPPI test. The bond pays only principal and the interest, so no leverage, no equity-linked features. So it also passes SPPI test. Therefore, the conclusion is this shall have to be classified as amortized cost. Okay. So in this case, the basic information is as follows. Now, we will have to find the discount rate that makes the present value of future cash flows equal to 950. We can calculate the effective rate smartly by using Excel rate function. And we get the effective interest rates 6.9. Okay, now we can develop the amortization table as below. Then we will do the accounting double entries. The initial purchase is 950. So we will debit debt investment and credit cash or bank. In the year 1, we will accrue the interest by using the effective interest rates 6.9. So the interest receivable is 65. and credit interest income with the same amount. When the interest is received, it will credit interest receivable, and at the same time debit cash, as well as debt investment, which is the amortization during the year. Then in the year 2, you will repeat the same process. And in the year 3, which is the bond maturity, you first accrue the final interest, and then when the cash is received, you will debit cash with the 50 coupon received and the 1,000 of the principal. At the same time, you credit the interest receivable and also the debt investment. It's not so very complicated with the amortization cost, but you will need to understand how the effective interest rates is calculated, and you will have to understand the amortization table, that the cash will always be the face value multiplied by the coupon rate. Here it is the 1,000 multiplied by the coupon rate 5%. Here, yeah, face value 1,000 and coupon 5%. And you also need to remember that the interest accrued should always be the carrying amount multiplied by the effective interest rates. Okay, then we will continue with a more complex and rather difficult debt instrument at fair value through other comprehensive income. In order to make it more sensible, I have also developed another scenario. For example, let's say the company buys a corporate bond for 950. However, this time the investment strategy is both to earn interest and to sell the bonds, depending on the market conditions. So let's still do the step-by-step analysis. First with the business model, because this portfolio is managed using a hold to collect and also sell strategy. Okay, and secondly, the SPPI test, because the bond pays principal and interest only, so it passes SPPI test. So the conclusion is it will be fair value through the comprehensive income. Okay, so the initial purchase, we will debit that investment, and at the same time credit cash with the amount of 950. In the year 1, let's suppose the fair value decreases to 940 due to the market conditions. So the general interest shall be firstly record the interest income, which is always based on the amortized cost. So we will credit interest income with 65 and 55, and debit cash 50, which is the face value multiplied by the coupon rate, and debit debt investment with the amortization of discount, which is 15.55. So far, it's the same as the aforementioned amortized cost. It's the same, okay. But then, as we will have to revalue it to fair value, because it's now 940. It's 10 less than the initial purchase price. And the current amortization cost is now 965 and 55. So there will be a fair value loss, which is 25.55. This is the we use the fair value minus the amortization cost. So we will debit other comprehensive income because it's a loss in equity, and then credit debt investment with the same amount, 25.55. So what has happened? First, we earned the interest income, which is 65.55, which will go to P&L because it's interest income. But the bond's market value fell to 940. So the loss, which is 25.55, will have to go to OCI. It's not P&L. So far, the balance sheet after year one shall be the assets 940, which is the fair value of the debt investment. And the equity is a negative balance. It's the OCI. It's minus 25.55. At the year two, let's imagine the fair value recovered a little bit. We will assume in year two, the bond's credit rating improves or market rates fall. So we assume the fair value now is 975. So firstly, we will do the interest accruement, which is based on the amortized cost. 965.55. So the interest income is 66.62. It's the amortized cost multiplied by the effective interest rate, which is 6.9%. and at the same time we will debit cash and also debt investments. The amortization shall be 16.62. It's the gap between cash received and the interest income. Now the amortized cost shall be the last year's amortization cost plus the amortization of this year. So it's 982.17. Then we will revalue it to new fair value, which is 975. We will need a net change in OCI, which is a gain of 18.38. Oh, yeah, we can go over these figures. We will then debit that investment with 18.38, and at the same time credit other comprehensive income with the same amount. Now, the total OCI reserve is negative 25.55 plus 18.38. It's a negative 7.17. Now we have come to year 3. Let's assume it's the first day of year 3. The fair value of the bond has increased to 1,010, and at the moment we decided to sell the bond before its maturity. Firstly, we will revalue to fair value from 975 to 1,010. There's a rise of 35. So we will first credit OCI and at the same time debit debt investment with this 35. And then as we have already disposed of the bond investment, so we will derecognize the bond investment, and at the same time we will recognize the cash. We will record the cash. So we will debit cash and credit that investment with 1,010. Amongst the 1,010, there's amortized cost of 982.7, yeah, which is we have calculated at the end of year 2, and we can also refer to the amortization table here. Yeah, it's 982.17. And at the same time, there's an OCI of 27.83, which is the sum up of the OCI this year 35 plus the accumulated OCI previous years, which is a negative 7.17. So it's 27.83. So together, we will de-recognize the debt investment of 1010. But we will do a further entry. We will recycle the OCI to P&L. Like I said, the OCI at the moment is 27.83. So we will debit OCI and also credit gain on disposal 27.3. So this is the recycling of OCI to P&L. For the debt instrument of fair value through other comprehensive income, when we dispose of the debt investment, we will recycle from OCI to P&L. This is very important. And it will be very different from the accurate instrument with fair value through OCI, which will not be recycled to P&L, which we will talk about later on. So before I continue with the next chapter, I'd like to require you to go through the scenarios and all of these double entries to have a very clear understanding of the debt instrument at fair value through OCI. And if you have any comments or questions, you can leave a comment and I will be able to respond to you at my very earliest convenience. Okay, we will continue with the debt instrument at fair value through P&L. Let's assume the company buys a structured note for $1,000, and the coupon of the bond is linked to the S&P 500 index. So we do the step-by-step analysis first. We begin with the business model, because the portfolio is managed on a fair value basis. It's basically for trading. And then with the SPPI test, this scenario, the SPPI fails because the coupon depends on equity performance, because it's linked to the S&P 500 index. It's not purely principal and interest model. So the SPPI test fails. So the conclusion is that this is a debt instrument at fair value through P&L. So at the day one, when purchasing, we will debit debt investment and credit cash 1,000. And then at every reporting date, we will remeasure the structured notes to a fair value. Any changes will go to P&L. Let's assume the fair value increases to 1060. Then there's a $60 increase of the fair value. So we will credit a fair value gain 60 and also the debt investment 60. But if later on it falls to 1015, so we will debit fair loss and credit debt investment by 45 to realize a net fall of 15. It's much simpler, isn't it? All right, we have spent a lot of time on bonds and loans, all those SPPI tests, amortized cost, fair value through other comprehensive income with recycling. Now, let's talk about something much simpler, equity investment. Just imagine the shares in Apple, Tesla, or the other startups funded by your friends. The rules for equity are dramatically simpler. The tricky part is about understanding why they are different. For the equity instrument, the default method is fair value through P&L. But there's also an option. You can designate the equity instrument with fair value through other comprehensive income. But you need to bear in mind that it's only for non-trading equities, and you will never recycle the OCI to P&L. And there's no expected credit loss for equity instruments. So it's quite different from debt at fair value through other comprehensive income. So for equity instruments, the default rule is fair value through P&L. So what happens when you buy the shares? Every time the share price moves, you recognize the gain or loss immediately in P&L. For example, you buy Tesla shares for 200 each share. So at the next quarter, they are worth 250. So you only need to debit equity instrument 50 and credit fair value gain to P&L 50. And then the next reporting date, they drop to 230. So you debit fair value loss 20 and equity investment 20. It's quite simple, isn't it? So why is there such a default? Because most companies buy equities either for trading or for other reasons like influencing the company. Both create volatility that belongs in P&L. This will give users a transparent view of your investment performance. Like aforementioned, there's an option of fair value through other comprehensive income. This is very interesting part. IFRS 9 gives you an alternative, but at the same time, it comes with significant strings attached. Let's suppose a scenario. Your company buys shares in another company, but not for trading. It's for a long-term strategic holding. You're not planning to sell them. You don't want the share price fluctuations have an impact on your P&L. So in this scenario, you can elect a fair value through other comprehensive income at your initial recognition. You need to bear in mind, number one, only for non-trading activities. If there's any intention to trade, you cannot use this. This is for genuine long-term holdings. And number two, the election is irrevocable. Once you choose fair value through other comprehensive income for an active instrument investment, you are stuck with it forever. No divorce allowed, no shift. Number three, never recycle OCI to P&L. This is the biggest difference from a debt at fair value through other comprehensive income. With debt, when you sell, you can recycle OCI gains or losses to P&L. But for equity fair value through other comprehensive income, the gains or losses will always go to OCI and stay there forever, even when you sell. Here's an example. Suppose you buy Microsoft shares for $300 and you elect fair value through other comprehensive income. In the second year, when the shares rise to $350, you will recognize the gain of $50 in OCI. So you credit OCI and also debit equity investment 50. So in year 3, the shares rise to 500 and you sell it. So you will debit cash 500. And at the same time, you credit equity investment 350, which means you de-recognize the equity investment. And the fair value rise of 150, you will also credit it to OCI. So the gain never hits P&L. It goes from OCI to retained earnings directly. The rule is to prevent any accounting manipulations. The logic is okay, you ask yourself some questions. Why there's no recycling for equity fair value through other comprehensive income? Because if gains or losses never hit P&L when you hold, they should not suddenly appear when you sell. Otherwise, you could hide losses in OCI forever and only recognize gains when it's convenient to manipulate the financial performance. Why it is irrevocable? Because it's to prevent gains trading. As switching to fair value through P&L when prices are high to book gains, then back to fair value through other comprehensive when prices fall to hide the losses. And when would you actually choose fair value through other comprehensive income? So it's only when you are truly holding it for long term and you want to avoid P&L fluctuations, and you accept that investment performance will not affect your reported profit. And practically most companies stick with fair value through P&L for the reason of transparency. I have summarized what we have talked about, and yeah, you can find here in the table. For the equity instrument at fair value through P&L and fair value through other comprehensive income. You can take it for reference to make a comparison, and then you can understand the two methods more clearly. And here are some real-world examples. Like you can imagine that when Warren Buffett, he is well known as a great fan of Coca-Cola. His investment company, Berkshire Hathaway, when it purchases Coca-Cola shares, and basically it has held it for decades, so it's most likely that it will use fair value through other comprehensive income. But on the other hand, when an investment bank like Goldman Sachs trading desk buys some shares, you can expect it will use fair value through P&L. Also, there are some common mistakes I'd like to highlight, like using fair value through other comprehensive income for trading equities, or expecting to recycle equity OCI gains to P&L, or you think that you can change your mind later. No, you just cannot. So far, we have widely covered debt instrument and also equity instrument. For debt instrument, they are amortized costs, fair value through P&L and the fair value through other comprehensive income. And for equity instrument, they are fair value through P&L and the fair value through other comprehensive income. I would say that's all financial assets about. And okay, let's now carry on with the next chapter, the financial liabilities. Generally, you can see financial liabilities are much easier than financial assets. And there are only two categories only, the amortized cost and the fair value through P&L. Yeah, I need to remind you that there's a very confusing part for many people, that if you measure a liability at fair value through P&L, the portion of fair value change caused by your own credit risk must go to OCI, not P&L. But even that, it does not mean the liability is a fair value through the comprehensive income. We will touch on that very quickly. So let's begin with amortized cost. That will be used by the bank owns bonds, lease liabilities, and other trade payables. And it works just like the amortized costs of financial assets, which we have spent quite a lot of time to make it very clear. Okay, I'd like to articulate the amortization cost with a lease liability for an example. And with this example, I will also show you how would you treat the right of use assets, which is regulated by IFRS 16 lease. I have structured a scenario. Suppose your company has rent a plant or equipment, which of which the commence date is the first day of the year, and the lease term is 3 years. The annual lease payment is 100,000, and the implicit interest rate is 6% per annum. And the right of use assets will be depreciated on a straight line over the lease term. We will first compute the initial lease liability, which is the present value of the 3 lease payment of 100,000. We use we can get the present value is 2,167,000. And in this case, it's the initial right of use asset, and also it's the initial lease liability. And for the straight line depreciation, it's divided by it's to divide the present value by 3, so it's 89,100. The interest each year will be the opening balance multiplied by 6%, which is the implicit interest rate. And the amortized cost, which is also the closing liability, is the opening balance plus interest accrued minus lease payments. And yeah, and then we can develop such a amortization table, which is exactly the same like financial assets at amortized cost. Yeah, it's very similar, right? The journal entries at day 1, we will recognize the rate of use assets, and at the same time, the lease liability. Yeah, it's the present value of the 3 annual payments of 100,000. Then at the end of year 1, we will book the lease payment by crediting cash. And at the same time, we will debit interest expense, which is the opening balance of the initial liability multiplied by the implicit interest rate. And also we will debit lease liability, which is the difference between the lease payment made and the interest accrued. Then we will also depreciate the rate of use assets, debit the depreciation expense and credit accumulated depreciation with the same amount of 89,100. Then at the end of year 2, we will repeat the same recording as in the year 1. And also in the final year, the accounting treatment is the same as previous years. And at the end of year 3, you will find that both the liability, the lease liability, and also the rate of use assets are 0, as reflected in this amortization table. Okay, I think it's quite clear. I assume you have understood the accounting treatments of financial liability at amortized cost. And in addition to this, you have also had some idea of IFRS 16. This is truly killing two birds with one stone. Let's move on to fair value through P&L financial liabilities. This is for the trading liabilities and derivative liabilities and the liabilities designated at fair value through P&L. In most cases, a company chooses fair value through P&L for a liability because it wants to match assets and liabilities. Like when a bank issues bonds and invests the proceeds in bonds, they might want both at fair value. There's a own credit risk twist, as aforementioned. It's when you measure a liability at fair value through P&L, and your own credit worthiness changes. The accounting treatment is counterintuitive. I'll give you an example. Like your company issues $1 million dollars of bonds at its par value with 5% coupon rate, and you designate them at fair value through P&L. Just imagine that your credit rating improves, which means you become more credit worthy, and the market information is, this company is much safer now, and then your bonds will become more valuable, and the fair value of your liability will increase. It's absolutely a bad news for you because you owe more if you use fair value through P&L. You would expense more on P&L. That just not makes sense, because you are actually punished by your better credit worthiness. Another situation is when your credit rating deteriorates, which means you become riskier, then your bonds become less valuable, and the fair value of your liability decreases. In this case, it's it's very good for you because you owe less, and you make an accounting gain from becoming riskier. That just feels wrong, doesn't it? Because you are rewarded by your poor credit management. So IFRS 9 says, for liabilities at fair value through P&L, the portion of fair value change caused by your own credit risk goes to OCI, not P&L. So to make it more sensible, let's walk through an example. Assume your company issues 5-year bonds for $1 million at 5% coupon, and you designate them at fair value through P&L. In the year 1, everything is well, and the fair value remains intact. It's the same. And the next year, your company has some tough times, and the credit rating drops from AA to BBB because you are riskier, investors demand a higher yield, and the fair value of your bonds drops to 950,000. So there's a decrease of 50,000 of the fair value. In front of this, we need to split two parts. One is due to the general interest rate. Let's say there's 10,000, and the other part is due to your own credit deterioration. Let's say it's 40,000. The first part will go to P&L, and the 40,000 part will have to go to OCI. And the entry is debit bonds payable by 50,000 and credit gain in P&L by 10,000 and OCI 40,000. You see, there's a differentiation of gains from the market rates and your own credit worthiness changes. But it does not mean the liability is a fair value through other comprehensive income. The liability is still a fair value through P&L. We're just splitting where the change goes. The reason why there's such a rule is firstly to avoid perverse incentive, because companies should not profit from becoming riskier. And then for better decision making, managers focused on P&L will not be tempted to damage credit. It's crazy. And then for transparency, users can see the real performance separate from the credit effects. And here's the catch. The amount going to OCI is never recycled to P&L. When the liability is settled, the cumulative OCI balance is transferred to retained earnings directly. Let's now sum up for takeaway. For the financial liability treatments, there are only two categories, which are amortized costs and fair value through P&L. But for the fair value through P&L, there's something a bit confusing because you need to recognize the gain or loss from your own credit risk changes to OCI, and rather than the P&L. The logic is that we don't reward or punish companies for credit changes in P&L. This rule creates a paradox, and the financial statements might show you doing well while your credit rating is collapsing. That's why analysts always check the notes about own credit adjustments in OCI. All right, we have so far discussed the financial assets and the financial liabilities. So before I touch the expected credit loss and impairment, and also derivative accounting, I'd like to go over the essentials with the takeaway list. First, financial assets classification depends on business model and SPPI tests. Secondly, the debt instrument can be at amortized cost or fair value through the comprehensive income or fair value through P&L. And thirdly, the equity instruments are usually fair value through P&L with an optional fair value through other comprehensive income choice for long-term holdings. Fourth, financial liabilities are either amortized cost or fair value through P&L, but part of fair value through P&L changes may go to other comprehensive income. And fifth, expected credit loss applies to debt instruments using the three-stage model. Once you understand this structure, then IFRS 9 becomes very, very manageable. Okay? I will make a separate video on impairment of financial assets by elaborating on three-stage model. Then I will also spare some time on hedge and derivative accounting treatments. See you soon.